Welcome to another episode of Millennial Investing Explained. Here's today's question. What investing advice do you hear given by experts that you think is inaccurate, sometimes makes you shake your head a little? And what do you think is the actual truth?
Okay, so I will tread lightly here, lest I anger an army of Bogleheads. So first of all, I'm a big fan of passive investing, right? So passive investing is great. I do a bit of passive and a bit of active personally. That's a longer conversation. But passive investing is great. But I think the enthusiasm of the personal finance community for passive investing and the recent 10-year fantastic market that we've had, I think that people have lost their sense of what risk is. I think people have lost their sense of what can happen. This idea that I read is like, just buy index funds because they always go up. And that has historically been true over the very long term, over 20 or 30 years. But most people can't stomach the ride that comes with that. So it's a little bit of a subtle thing, but I just think the average investor has lost his or her sense of how dangerous markets can be. If you look at the history of investing, the average intra-year drawdown over the past 30 or so years has been about 14% a year. We lose double digits just about every year at some point in the year. Usually that comes back. But every single developed market in the world has had drawdowns of 75% plus, including the US. And so markets can get enormously choppy, even if you're well diversified, even if you're doing smart things like diversifying and managing fees. So I think it makes the case for broad diversification within and between asset classes. Absolutely manage those fees, absolutely get international exposure. And just remember that the reason that markets pay so well is because they have tended to be very, very choppy, right? The reason that stock markets pay off nicely is because there's an insecurity premium that comes with all that volatility. And don't let the fact that we haven't had it recently blind you to the fact that it really is probably likely to be there in the medium to long-term future.
I love that point. And I think it's hard for us to just talk about and for people to really conceptualize because, like you said, over the last 10 years, it's just been a bull market. And a lot of people listening to this show, and even a lot of people in the financial independence retire early community that are really into personal finance, have probably retired in the last 10 years. And so all they've had is a bull market. They might not even have invested in 2007, 2008 when things really go against you. So you got to remember, like you said, that things don't always go up, and it's going to be really interesting for how people react when things start to go against them like they did 10 years ago.
I think the general thrust of the FIRE community is so positive, learning to save, learning to invest, learning to live with less, learning to eschew sort of wanton consumerism. All that is really positive stuff. But I do get concerned when I read these articles of, speaking to the very same thing that I'm talking about. It's like, hey, this person retired, they saved $500,000. Now they retired and they're going to live off the 4% rule. They're going to live off 4% a year. And that $500,000 could very quickly become $250,000 if you're not careful. And you've got to be aggressive enough. If you're going to retire early, you've got to be aggressive enough that you can keep up your purchasing power. And doing that means taking a measure of risk. So, by all means, work hard, save, invest, manage those fees, brush off consumerism, but just be a market historian and know that things can get really, really choppy, and be humble about that as well.
Yeah, I love the community and the overall mission of that incentive in general as well. But it's so tough for somebody to conceptualize that without actually being through it. We can say, that you're going to have to see your portfolio go to 250, but you're not going to really know what that's going to be like until you actually log into your account one day and you've seen over the last 3 months that your account got cut in half. That's a whole nother psychology test that you have to go through.
Man, I can't do it. Godspeed if you can. I know myself, I would freak out before it got to 250. So that's tough. That's what de-risking assets are for, right?
Well, and that's why you have a financial advisor, right?
That's right. That's why I have a financial advisor.
That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.